proceed to item number 2 is a consent agenda. And that is the minutes of the regular meeting from last year, on February 7th. Discussion. Any action on approval?
Second.
I'm sorry, who made the motion?
David.
Okay.
Tracy?
Greenville,
Aye.
Loftus,
Aye.
Reister,
Aye.
Webb,
Aye.
Sack.
Aye.
Moving on to business is item 8, report from CIBC Investments. Come up, Aaron.
Thank you.
Stand.
And you all received everything beforehand, right?
Yes.
Digitally? Okay. Okay.
Summary.
Right.
Yeah. So we've got the books that you have in front of you. Hi, good to see everybody, first of all. And we'll just walk through it page by page, and obviously, as always, open to whatever questions you all want to discuss.
You might pull the mic closer
Oh,
to you.
thank you.
We're doing this live, so.
Thank you. So we'll go through the book that you all have a copy of, and as always, please interrupt us with whatever questions you all have as we present. Starting with the first tab, this presents the allocation of all of the monies that we are charged with as of December 31, 2019. If you look to the upper left pie chart, you'll see we ended the year with 2.5% in cash, 36.4% in fixed income securities, and just over 61% in equities. You'll see that the total monies added up to $48,105,208, and then on the right breaks that down by types of specific strategies. So, for example, taxable bonds, 30%. Follow that down a few to equity income. Those are dividend-paying equities. Below it, all cap are small, medium, and large, traditionally non-dividend paying equities like Amazon, which we'll get into some specifics in a bit. Small cap equities at a bit under 5% of the portfolio, and international equities at a bit over 9% of the portfolio.
And further down, and then it delineates in each account. So we have about, 7 accounts, including the sub-account, where all of the monthly income pours into. And then below that, you have a separate box depicting the original investment policy statement. So it sort of tells us, obviously, if we're in the targets, near the targets, and within the allowable ranges, which is a check. So the targets are about 60% stocks, 40% bonds, and in the allowable ranges gives us a little bit of latitude, but we're well within our guidelines there. The household overview, the next page, which we call also our report card, which is the performance, is on the far right, on the top, activity summary. So inception today, we started with 30 million in the initial portfolio size. We have distributed about a little over 11 million. The unrealized gain in the portfolio is 29,213,000, and we're sitting at, as Bruce said, at the ending market value of about 48,105,000, which translates into a investment return after fee of over 8%, 8.18%. 2019, and we'll go into specifics, was a terrific year for the stock market. I think in terms of Wall Street standards, that was the big surprise, is that the stock market did perform so well. Year to date, with your allocation, in 2019, the return on the portfolio was 24.42%. That's a net of fee number, which is pretty strong, given that you have a pretty good balanced account in fixed income. And then the performance summary at the bottom right quadrant, that depicts the performance on each strategy or portfolio, and each account is kind of housed and it's different for the different portfolio. So the fixed income portfolio returned just under 6.5%, and Bruce will explain that it was an unusual strong year for bonds, as well as stocks, which is, we'll take it, right? Equity income, the dividend portfolio, is 36.8%. The growth portfolio was 36.4%, and those two kind of usually are very good complements to each other. They both actually performed extremely well. Just to remind you that the S&P 500 was up 31%, so both portfolios outperformed. And the international growth at 31.6%, small cap at 41.6%, and then we still have a remnants of a natural resources that doesn't have very much money in it, obviously. And then we have the sub-account, which has been mostly invested in cash now. And that was in a transitionary phase too in 2019.
Right. Any questions on any of that performance? I would maybe just add one thing on the performance if I could, which is the graph on the lower left of the page that Aaron just went through. You see on the upper right of that graph the number 110. That's showing you that cumulatively the account has made 110% of its money. So with us sitting here at about our 10-year anniversary, a little bit more, ignoring the money's taken out, obviously, but you've basically doubled, a little bit more than doubled the funds in the trust. The next page sort of zooms us back out, and as Aaron said, it shows, if you look at the U.S. stocks year to date, that the S&P last year was 31.5%. It also shows what the markets have done for both the last 3 and 5 years. A couple of interesting things I think on this page. One, if you notice, over the last 5 years, U.S. stocks are up almost 12% a year, while international stocks have been up less than half of that. One of the things allocation-wise that I think we've done a good job at is you do own some international stocks, you haven't owned a lot of them, and that's helped contribute to the strong performance that we've had. A corollary of that is that we actually think there's good opportunity in international stocks, so our intention is to not dramatically, but on the margin, increase international stocks a little bit because we believe that valuation gap will narrow over the next couple of years or so. And then the other thing I would point to, Aaron already mentioned the strong year that bonds had. If you look at the bond section, and long-term treasuries is misleading because we're not going to have a portfolio of all long-term treasuries, but even the intermediate bond sector, you see it there, intermediate government corporate, up almost 7% last year. And this is in a world where interest rates are 2 to 3%. So clearly what happened is we had a decline in interest rates that caused the price of the bonds that you and others owned to appreciate. And it's as Aaron already did say, it's unusual to get such a strong performance in bonds and stocks the same year. And again, that's what contributed to an overall strong performance.
And then on the commodities too, they actually kind of turned around a little bit. It's been quite soft, as you all know, in the energy sector. So trailing 5-year in oil was negative 2%, but on the year to date, actually oil did sort of rally during the year at 35%. And then gold also at 18%. We anticipate that this commodities will improve. We've got a massive global easing around the globe, global easing, and especially in the U.S. as well. We do believe that interest rates will probably go up a little bit. Also with the prospect that GDP should improve in the second half of the year. But we also believe that we're starting to see a little bit of signs of inflation, especially on the average hourly earnings. We've got a tight labor market. It's becoming a little bit tighter. So that typically, at least historically, has been the first kind of precursor to inflation going around to other commodities.
And then the next page, and we won't obviously go through all of these, but that just gives you every index that you could probably possibly want to know. So if you're curious, okay, the S&P was up 31%, what was the Dow up, so on and so forth, you've got all of those there just as a reference.
And if we actually pull Bruce was right about the international. We've been quite light in the last 5 years in our allocation, but we would like to increase that, obviously within the stock allocation. But our international strategy is up 31%. versus the benchmarks were up about 21%. And so, again, our international we're trying to find really good companies internationally. We don't wake up and say we need more exposure in Japan. We let the quality of the company dictate our country allocation. So it's a little bit different than other managers.
And the last page of that section, we just gave you a summary of the sub-account cash flows. So you see that for 2019, total distributions, 1.3 million and change, of course, I'm rounding. And then you see the medical allocation over on the right. And then we've given you grand totals that have been distributed and total withdrawals that have been made, just to give you a perspective of where that stands over time.
Okay, so in the total distribution column there, the 11 million that you,
Distributed since inception.
yeah, 11 million, 108, that should be that same figure, shouldn't it?
11,108,000 and 11,000,000.
073, approximately the same.
Yeah, it's approximately the same.
But
There might be some,
Well, actually, it's ADR fees as well.
Yeah.
ADR tax.
yeah, it's probably something like that. Some of the international stocks we own, there's taxes and so on. It's probably, but you're right, that's the same. So it's alluding to the same thing.
So the 2,000,001 is part of the 48 million still.
Correct. That's a good
Yes.
point.
Okay,
Yes.
now, if you distributed that 2 million all out, then it'd be 46, down to
Right.
46.
Correct.
Okay, that's
Correct. And that, Mark, you make a good point also as far as performance goes, because while we're pleased and hope that you all are to be up 24.4% this year,
Yeah.
keep in mind 2 million or so that's in the sub-account. Per our mutual agreement, we've gotten out of securities and you're basically sitting in a money market fund earning 1 point something percent. So that performance would actually be higher
Right.
if you took out the drag of that cash portion.
Right.
Okay. If you go to the next tab, and our belief is that you're not going to want to go through all the holdings of the account, but obviously we will to whatever degree you want. But what we've given you is each of these subsequent tabs is the various portfolios that you're invested in. So the first one you can see is the intermediate bond strategy on page 10, and then we go on to just show you as of the end of the year all of the specific holdings that are in the intermediate bond strategy. Again, not to go over all of those, but maybe to take a quick jump to page 18, what we've then given you, and you'll see the book follows in the same format for the other strategies, we've given you the audited performance strategies as of the end of the year. So this relates to, you're in strategies, so this relates to the aggregate of all the people in this strategy, but it just gives you some nice statistics if you're curious what's the average maturity of the bonds in the portfolio and so on and so forth. You've got all that there.
And then behind tab 3 is our all-cap growth strategy. If you recall, this is a portfolio that's comprised of about 36 different stocks, really focused in the high growth sectors, primarily the technology, discretionary, and a little bit of cyclicals right now, and biotech healthcare. This actually has had a terrific, since inception, 1994 has had a terrific performance against the peer groups and benchmarks. If you'll see on page 24, which again is the composite of the strategy, and gives sort of a top-down look at the characteristics. And you'll see that since inception, this portfolio has returned on an annualized basis 14.2% versus the index of 9.6. So we're tracking about 4.5 plus better than the market after fee. Not all years and not all quarters of you're well aware in our relationship for 10 years that we are outperforming, but this is certainly an active strategy and focus on those companies that really on the tech side are really the disruptors of our economy and how we our shopping behavior and how we use the internet and productivity and all that. So it's fun to go through the names, and we're happy to walk through. I would say a lot of people think that Amazon would probably be the number one, but actually MasterCard has been a true outperformer. You've heard of Bitcoin and FinTech. MasterCard and Visa are a great way to play that. They're the giants in the industry in terms of building a blockchain, and every time we go shopping around the globe, they get 1 to 2 cents on that transaction, and their operating margins are about 51% today. So that's a great way to invest in sort of FinTech and the buying behavior of the U.S. consumer, which has really almost never been stronger today. The U.S. consumer is extremely healthy and out shopping, as we saw in the holiday. And then, of course, we go into different types. Roper Technologies has the RFID card in all the universities. Every time or even those little ID cards to get you into buildings, everything's interconnected. So that chip in there, they really build Roper Technologies. Kind of interesting names that you might not have heard, on CNBC, but we try to find, the next Wall Street darlings. Behind page 4 is our dividend strategy, which is the complementary strategy to AllCap. This portfolio, because of its dividend, typically does better in a late economy, late cycle, or even recessionary environment. But it actually did extremely well, this year as well. They met the AllCap growth performance at 35%. And this is concentrated, only has, again, about 35 to 39 names. And it's has a lower beta overall than the market. So you're getting a nice risk return on this portfolio. It's been a terrific portfolio for many of our investors. And you can look at the top 10 holdings on page 31. Many of them you've heard before: Microsoft, Apple. They're kind of going head to head, obviously, in the tech world. And then, of course, Abbott, JP Morgan, etc. And please ask questions along the way. Conversations are great.
So the next tab is the international growth strategy. Again, you've got all the holdings listed. Again, we won't go through every one, but if you go to the performance composite page on page 38, actually go to page 39, what you might find interesting about this strategy is to look at the geographic diversification of the international strategy. On the bottom of page 39 on the bottom left, you can see that you can see a couple things. You can see the top bar is what we own, and the bottom bar is the index. So we are not afraid to deviate a bit from the index. We're not going to go wildly different, but we will deviate. So Japan, for example, we own 12%, the index owns 16%. And then, of course, you can also get a snapshot about what the largest geographical weightings are, UK, China, France, etc. Again, this is a strategy that historically we've been underweight in on your behalf. Our intention is not to move to an overweight, but to increase it a bit on the margin. And as Aaron pointed out before, and this one's worth pointing out again, I think, last year this strategy was up 10% more than its index. The international index was up 21, this was up 31. And if you look at over the last 3 years, 5 years, 10 years since inception, this team has actually consistently outperformed its benchmark in a investment landscape, the international landscape, that's been very difficult to do well in. So we're particularly pleased with the way they've navigated this.
And the small cap strategy, that was actually the star performer at 41%. Small caps did remarkably well last year. We do not have actually a composite reporting on this. This actually portfolio has been closed, so lucky you can still stay in the strategy. But it's closed to new investors, so we have not had a report here. But small caps, this really focuses on companies that are either emerging growers, kind of incubation growth, kind of just public, as well as consistent growers. And a lot of times this will be sort of the I would say breeding ground for all cap growth. And so we'll have some overlap a little bit in this from the small cap to the all cap. And again, this was just about 6%?
Yeah, 5 maybe.
Just 5% of your strategy, right? The small cap.
Yeah. And you eyeball any of the names in small cap, probably not surprisingly, this is where you're gonna know the least of them, or maybe international, but between the two of them, you're obviously not gonna see the household names like you would in the other strategies.
I bet they know Chewy's though.
I was gonna say, I recognize.
Or if you have children, Five
You'll
Below.
listen.
Right, that's
Right,
it.
right, right. And then tab 7 just shows you what the sub-account currently looks like on page 46. And hopefully to nobody's surprise, we've got 100% cash, as we've all discussed and as we just mentioned. You can see we've got the majority of it in the Charles Schwab Value Advantage Fund, and that's simply because the sweep doesn't really pay a high rate of interest, and when we buy, that's a purchased money market fund, and that's the way we can be in cash and still get you, as it says there, it's about 1.7%. The bit that's in cash is probably just the distribution that was made at the time, so we're always monitoring that and making sure that, but obviously there's money coming in and out at the time, which is going to be in that actual cash line. Any questions about any of that?
So how does the 3 million compare to the 2 million?
Profit, basically. So,
That's a cost accounting, what you're saying.
yeah, the 3 million, if you go back,
Total cost basis is 3 million.
Right.
But what's actually in the fund's 2 million. Now, I don't follow that.
so, yeah, you're on page 8, right, Mark?
I go from page 8 back to 46.
Right, so so this shows, page 8 shows that there should be 2 million in the fund, and yet you've got 3 million in the fund. So you're asking, what's the extra million? And that's just, remember, page 8 is what we just, page 8 doesn't include any profits. It's just the amount of money that was deposited into the sub-account. And then we were investing the sub-account, which is earning interest and appreciation from stock. So it's grown to the 3 million.
I see.
And we had previously a discussion that we would eventually allocate that pro rata, the appreciation, the income and the appreciation to the sub-accounts when needed.
Right, and if you cleared everything, brought it up to date, and actually sent it out,
It would be,
you'd be distributing 3 million.
that's right.
Right.
Gotcha. And the reason it's not distributed out, it hadn't been called for.
Right.
Right, that's the residual. Right.
Gotcha. Well, this is really good. This is a good report.
And we even have page numbers.
Yeah.
It does make it easier.
That's wonderful. Yeah, this is really
Good.
fun times for investments.
We're pleased, we're pleased.
I bet you are. And you've moved to Dallas. I don't know whether you
Yeah.
all knew, she used to be in Chicago. Both of them are in Chicago. She's now in Dallas.
Yes.
Opened the office there.
That's right.
But just wanted to be closer to us.
Right.
Exactly.
The 1 million, between the 2 and the 3, is that, they're still drawing like 1.6 or?
Yeah.
You said,
All
Yeah.
of it. All the 3 million is earning 1.6, 1.7.
The more you invest at tiers at Charles Schwab, the more you invest, you can get a higher yield in the money market. So that's actually a pretty good yield, 1.7,
Yeah. Yeah, that's correct.
Charles Schwab,
Mhm.
representative right there.
Mhm. Well, congratulations to you.
Thank you.
This is wonderful. And the funds up to what, 48 million? That's terrific. If we wouldn't have taken out the 11 million, we'd be at 59 or 60 million.
Correct. Yeah, because it's been up 110%. So
Yeah.
Basically double.
Yeah.
But the city appreciates all the money that
Oh,
has
yeah.
come out.
Right.
We
You can
need
tell.
it.
We get it.
That's the purpose, yeah. And then the next section is the financial markets monitor, which is sort of our kind of a recap of the year as well as our outlook. We are not anticipating in encourage our clients not to anticipate another 31% on the stock market year. But we don't see a reason why the bull is going to die. I mean, it doesn't die of old age. I'm sure you've heard that. It's been sort of on page 48. It's a tortoise, economy. In the sense that we've had very slow, kind of drawn out growth. 2016 with the tax reform was a bit more of a stimulus, and we're seeing that kind of play out now, especially in the employment picture. We anticipate returns, we were talking about that on the way up here, but anticipate returns probably in the high to mid-single digits, and yet here we are at 5% year to date. So we're it's been a while, it's been over 12 months for any kind of pullbacks, any meaningful pullback. Market correction is 10% or more, and an average market correction in any calendar year has been at 14%. So don't be surprised if we see a little bit more, bleaker days in the first quarter. We're anticipating GDP to pick up in the spring, end of spring and summer, and so especially with the global developed countries as well. If we get further tariffs rolled off, that should really be a stimulus for global growth that we do need in our international trading partners. So we're positive, but we're not cheerleading for another 31% year. But it should be more volatile, especially with the election and all that. It usually increases volatility.
And then page 49, I mentioned before that what an extraordinary year it was for bonds to be up 7% or so, starting from already low interest rates. And this is kind of an interesting chart because it shows you what the range has been for interest rates in each of these various decades. So for example, in the 70s, interest rates ranged from roughly, this is kind of remarkable, but from roughly 4% to 14%. That was a crazy time. But look at the decade just passed. You can see that interest rates generally were in the tightest and lowest range that they've been since the 60s. So we're going into 2020 with very low interest rates. Bonds just appreciated, interest earnings plus appreciation, 7%. The odds of seeing, as Aaron said, the odds of seeing the S&P up 31%, pretty low. The odds of seeing your bonds up another 7%, pretty low. This is a year where if we earn the interest on the bonds, which is low, which is less than 2%, that would probably be the best we could hope for. So, you give it lemons, you make lemonade. We're going to continue to do the best we can, but it's a tough interest rate environment for earning money on fixed assets.
It'll be interesting as we head toward November.
It will be very interesting. It's one of the big surprises, I guess, just to see what happens. But yeah, it's going to determine a lot. So page 50. We kind of talked about this in one of the previous slides where we looked at 10-year returns. But this is kind of interesting because it's just showing you over the last 10 years. It breaks out what various things have done because we're completing a fantastic decade, but coming out of a financial crisis, right? So you would expect that. And as you can see, every number on the right there, with the exception of the commodities, the exception of oil and commodities, every other number is positive. So it's been a strong year, almost whatever you were invested in, but also it obviously mattered. You wanted to be in the S&P 500 more than anything else.
And we mentioned before on the investment theme, sort of our outlook. There's that old adage about don't fight the Fed or don't bet against the Fed, and that's alive and well. We're in a tremendous global easing cycle. It continues. Even in the U.S., we have injected liquidity into the overnight market. That is another QE, although Powell will never admit it. But and he came out this morning saying that they're looking at the coronavirus, and if it should cause some slowdown, obviously on the suppliers, manufacturing suppliers, that he stands ready. So everyone's ready to inject more liquidity into the system, and that old acronym of TINA, there is no alternative, really applies here. So again, Bruce is saying very low rates. We can get a dividend, above any kind of 10-year treasury. So it really pushes more investors into risk assets, into stocks.
We won't go through every single chart. but happy to address any that you want. We can, but I'll continue my emphasis on interest rates. I'll point to page 53, and it shows you that if you look at international interest rates, so the graph on the upper right is emerging market interest rates, and you see that in the emerging economies, the Chinas, the Brazils, and so on, you have interest rates down at the lowest level that they've been. The point of this graph isn't just interest rates. The point is it actually spills back over into the equity argument. Central banks around the world still have their foot on the gas as far as liquidity goes. So to the degree that that's a driver of asset prices, and it is, that tells you that at this point, the central banks are not taking away the punch bowl just yet. So that gives us reason for optimism for continued stock market expansion, and also goes back to the idea we mentioned of increasing exposure to international, because when you see this kind of a trend, hopefully it means that international markets are going to start to pick up some of their pace as well.
And I guess this all comes back around to sort of what next in terms of allocation. We like the 30 to 35% fixed income allocation right now. There's no reason to increase it, as you know, because rates are so low. But in terms of where do we go for more growth, and that would be probably an international strategy on the margin. Maybe increase it, 3 to 5%, but without sacrificing any, without increasing your overall risk. And then probably remain the course, besides international.
And is that something that you guys make a recommendation and then the trustees would approve, or do you just do that automatically?
As long as we stick within the parameters that we're sort of constrained to, we just do it automatically.
Those allowable ranges, right?
Yeah, we don't tend to do just stylistically dramatic shifts. There are more little tweaks here and there, but we don't get a consensus on specific moves as long as we remain within acceptable range.
Okay, thank you.
If there were extreme environments like 2008, we would reach out to the trustees and say we'd want to do something, outside the ranges, maybe raising significant cash or what.
That's fair. And then, again, not to go through every page, so we'll jump to 57. This just highlights, this is price earnings ratios, so basically speaks to how expensive are stocks. And as the chart says, you can see it there, the current PE range is at the higher end of historically where we've been. This is going all the way back to, this is the average PE going back to 1940. So we don't have our head in the sand and say stocks are cheap. In fact, we're not saying stocks are cheap. We're saying they're at the higher end of what's normal, but they're not abnormal. It means you have to be cautious, but it doesn't mean the bull market's over. It's also, in a vacuum, this chart can be misleading, because if you have stocks valued at a certain level and bond interest rates are 6%, it's very different from stocks valued at the same level and interest rates as they are today are 1.5%. So on a relative basis, we would still argue they're reasonable, even though on an absolute basis, they're definitely towards the more expensive end.
And right now, for first quarter earnings, we just focusing on the PE, focusing on the E. We need more earnings to justify a higher P price. And we're getting it. 70% of the S&P 500 companies have met or beat expectations, so it has been a good reporting season. But we're still thinking there'll be a little bit of a slowdown, teeny bit slowdown in GDP, and then another pickup towards the back half of the spring. And then politics, I guess, on 58. So we probably shouldn't. That's not polite to talk about politics. But really in the presidential election, it's caused in 2016, it caused a lot of volatility, and we don't think it's going to be any different this year. There's a lot of polarization, as you know, in the political landscape of our country, so there should be a lot of rhetoric and that uncertainty. What the market doesn't like uncertainty, and so the market gets volatile when that happens. Strap on a seatbelt, it's going to be volatile out there.
And then page 59, this is not geared to you all per se, but our asset allocation committee, of which, by the way, Aaron sits on, is constantly coming up with guidance as to suggested, not mandated, really input for us as your advisors, suggested ranges as to what they think is appropriate for a very aggressive investor, a very risk-averse investor, so on and so forth. So we included here just the recommendation for a moderate risk, and you can kind of see for yourself what they're suggesting. Core bonds at about 32%, so actually in line with roughly where we have you all allocated. Some of this is a little misleading, like global equities at 41 is obviously lower than where you are, but in this version, they're counting real assets like MLPs and some real estate, which we own, like real estate investment trusts. They're breaking that out, so if you added it all together, the way that we think about it, you're really in line with this moderate risk, maybe slightly more aggressive than this moderate risk portfolio. And the key to understanding that is the 32% fixed income. You can see also in the comments, global equities overweight, fixed income and cash underweight. So the argument is don't increase your bonds right now, as Aaron said. Similarly, you'll see within international, there's an advocacy on the part of our allocation committee to increase international as we're suggesting, including emerging markets in particular.
That's all we have. Any questions?
Very good. Very good.
Very good report.
Thanks.
Thank you.
Yes, it's fun for us to be able to tell you guys that after 10 years, you doubled the money of the account and averaged over 8% a year in a moderate risk portfolio. And it's gratifying for us to see that the city's benefiting and at the same time that the funds are growing. So it's nice to see that.
And to see the hospital plan.
Yeah.
Yes. Puts a little tangible.
Yes.
It's after your fees too.
Yep.
Yes.
Well, that's a great job, great report.
Thank
Very
you.
good.
Thank you.
Thank you, Aaron. Thank you, Bruce.
Thank you very much.
Any more questions? Thank you. Thank you very much.
Thanks, everybody.
Okay, moving on to item B, more reports. It'd be the report from Bank First on our investments there.
Jared, do you bring your group in?
Sure. Sure, that is.
Could you give one of those to Frank Crawford out there?
Oh, thank you. You got an extra one? Okay, thank you.
Well, good afternoon. As a reminder, my name is Monty Curry. I serve as the administrator for this account. I'm out of the Tulsa office. Steve Winkler is the investment officer. He is out of the Oklahoma City office. 2019 was an amazing year. I don't think any of us would have anticipated the returns that we saw, but we'll take them, and certainly you benefited and enjoyed that run up as well. 2020 could also be an interesting year, and a lot of number of indicators we're watching now that have our attention. You're probably already aware that we once again have an inverted yield curve. So that issue and others, Steve will be happy to address any questions you have. So as in the past, we'd love to have a dialogue. So if you have any questions during the presentation, please feel free to stop us, and we'll be happy to
you as well. Always great to be in front of the group and give a report. And as Monty said, two things. 2019 was a really good year, and the second is, just like he said, I'd love for this to be a discussion. I have the high level that I'd like to go through and would be happy to dive in deeper to any questions you may have and want to make sure it's a good use of your time. I'm impressed by a little technology I see around the room. It looks like you guys have made some upgrades since last year. This is nice. This is really nice to see the improvements in the city in general. Looking at the first page, page 1, which is titled Market Returns through January 2020. So this is just a high-level overview of the market. I know you got a little bit of an overview in the prior presentation, so I won't belabor this. This actually is through January. So it includes this January, rolls off of January 2019 when we look at the trailing 12 months. January 2019 was a really good month in the market. January 2020 wasn't as good, but still we see over the trailing 12 months really strong performance throughout every asset class. And this is really great performance in most all of these asset classes in proportion to what they usually do. Small cap did not do as well in January as some of the other classes, so it's the only one that is up only 9.2% for the year. But if you look at large U.S. stocks at the top there, 21.7% gain over 12 months. Trailing 3 months to the left, you see up 6.7%, so a really strong performance there as well in large cap stocks. Large cap U.S. stocks continues to be the star performer, but it was challenged a little bit last year by long-term fixed income. Of course, that's driven a lot by what's happening to interest rates and in the broader economy. But interest rates for most of last year came down, and as rates come down, bond prices come up, and that is most accentuated on the long end of the curve. So that's why long-term fixed income did so well, but really short and intermediate term did really well by their own rights as well. Real estate also was benefited by interest rate movements. The real estate market continues to look strong, and so that was another healthy contributor to growth for those who had real estate exposures. See in the economic data below, most of this is really good news. We would definitely look at this as pleasant news. You look at the unemployment rate being very low at 3.5%. It's actually 3.6% as of last month. This is through December. Inflation continues to be right in line with targets, and you can see what's happened in the Treasury rate market. Monty alluded to the yield curve inverting, where we're not paid as any kind of a premium. We're actually paid less on long-term fixed income than short-term fixed income. We continue to see that cropping up in different aspects of the fixed income market, U.S. Treasury in particular. And you can see that here in this chart where the lines are really close together, the red, the blue, and the green lines, 1 year, 5 year, and 10 year, all really tightly bound and at times a little inverted from one another. That's a concern. That's something that gives us a little bit of reason to not be totally optimistic. And as we look at GDP figures in that last chart, you can see that trend is down a little bit. So GDP softening, interest rates falling. That's a bit of a concern for what's going on in the economy. We'll get to our outlook later, but first, if you'd like to turn to the asset allocation tab, page 2, you can walk through how the portfolio is invested as of the other day. So this is updated for February 10th, and that's going to be the close of the prior business day. You can see the accounts total value, $6,405,000. It continues to be invested in a 60-40 allocation. That's how it's invested. You can see on the top pie chart. Looking at the second pie chart, we can look at how equities are invested at a subclass level and talk about the only thing that's really changed since we met last, and that would be a slight reduction in large cap core with the introduction of real estate. So you see that little sliver of orange. That's real estate through a real estate investment trust. We added that back in the end of May of last year, feeling like it's a good diversifier. We like the real estate exposure in general. We've always had an indirect exposure and own those same companies in the other aspects, but we'd like to have some dedicated real estate exposure long-term for its diversification benefit. Also thinking when we get into a recessionary environment, whenever that does happen, it probably will perform better than large cap core, which is where we took the money from to fund it. The total of the equity group is $3,829,000, or a little bit above that. But turning the page, we can look at the fixed income breakdown. And to remind you, when we look at fixed income, we don't want to take risk. We want stability in our portfolio. We want it to be a source of funds in difficult times. We want it to give us some stability against what we expect to happen long-term in the equity market. And we like it to be plain vanilla. This actually looks even more plain vanilla than we met last because we have made one change in a couple of different stages, and that is to reduce that category in orange, foreign bonds. That's international government, international corporate bonds, high quality credit. They have performed really well. They've performed really well for a number of years. And in fact, they've gotten a little bit out of line with history in terms of where they are versus U.S. bonds. And it's so far out of line that we felt like it was probably to be expected that U.S. bonds would outperform international bonds in the coming years. And so back in June, at the end of June, we trimmed that from a target 15%, we cut it in half to 7.5% of our fixed income, and continued to feel like it was the desirable move to make. And then in September, we trimmed another 5% of that 7.5%. So there you're left with that small sliver of 2.5 or 2.4% in international bonds. So far, that's been a really good move. It really has closed that gap between U.S. bonds quicker than we thought it would. We'll continue probably, though, to have that allocation for some time as we think U.S. bonds are still poised to outperform international bonds, and again, with some give and some take, but over the coming years. The next page, page 4, shows what you actually own, the actual managers and securities in each of those slices of pie. You can see the fixed income group comprised of 5 different funds. The newest fund in that group is the Vanguard Total Bond Market Index. So when we reduced our international exposure, we just looked to get indexed exposure and use the sister fund of that international fund, knowing that we just wanted the index exposure. We didn't want any manager-specific risk there. In the equity category, those are all the same names that we had last year when we met, with the addition of the Fidelity Real Estate Index. So when we look to add real estate exposure, we did a search, looked at both active and passive funds. Didn't feel like there was an active fund that could justify their fees, and so instead we opted for an index fund. Usually we've gone with Vanguard, and they have always been the dominant player in index fund investing. But Fidelity had 2 things going in their favor. One is they were a bit cheaper than the Vanguard fund, and more importantly to us, they had a tighter tracking error. They had less tracking error. They mimicked their index much more closely, and that's really important to us in index investing, so we opted to go with Fidelity. But let's turn now to the historical return summary. Should give us a good overview on one page of our performance history and where we've been. You can see we've got, going down the page, year-by-year calendar results, and of course in 2010 it begins in October, but all the others are full calendar years all the way through 2019. And I'll point out a few things of interest. If you look at the beginning balance column, you can see we began in 2010 with $4,435,000. And then if you were to go over to the ending value and go all the way down to the bottom, you can see we ended the year with $6,359,000 roughly. Over that time span, we have had withdrawn $1,965,000, had fees of about $338,000, and an investment gain of about $4,226,000. That all translates into different rates of return. I'll just highlight a few of them. If you look at the 2019 and the since inception, going across to the right, you can see gross of fee and net of fee returns. I'll just focus on the net of fee. 2019, the portfolio grew at 17.9% net of fee, and since inception, it's grown at 7.6% net of fee. Now, the next tab is going to dive into a lot more detail on performance. I'm going to turn to page 8 and highlight just a few other additional points and probably relate back to a few that we just mentioned. So on this page, towards the middle of the page, you can see the investment gain loss line. And this is a report as of the end of December. So when we see last month, that's the month of December 2019. In that month, we were up $128,000. That's about, you can see down below there a little bit and off to the right, about a 2.1 or 2% net of fee rate of return for the month itself. And in the last 12 months, which would be the calendar year 2019, $1,027,000 investment gain, which again, back to those figures, 18.7 or 17.9% net of fee rate of return for the year. We can also see for the entire report period, as it's termed here, which would be since inception, the gain is $4,226,000, as we mentioned, and that translates into 7.6% for the entire portfolio annualized. A few other things to note on this page and the next. On that last 12-month column, if we break down just the portion that's invested in bonds, the bond portfolio has done really well. It's in blue. For the last 12 months, it was up 7.7%. Compares real favorably to the benchmarks. The Bloomberg Barclays Intermediate Government Credit Index was up 6.8% over that time span. So with that outperformance, a little bit of underperformance on the next page in the equity section. If you look in green, your portfolio up 26.8% for the last 12 months. It's actually very in line, if not slightly above, when we look at the entire world equity market, which was up 26.4%. But as we compare ourselves to just the S&P 500, which did better, it was up 31.5%. We underperformed a little compared to that index. Of course, that was the best performing subclass in that category. So it's hard to ever be better than the best. In fact, it's impossible when you're any different than the best.
Back on page 8 there, since inception, you've increased 95% since inception, almost double.
Yes,
Right.
yes, yeah, from 4.4 to 4.2, correct. It's been a good 10 years in the market. We participated. Page 10 has some calendar year returns. Pause there just to give us a chance to talk about. 2019 was a bit of a surprise year. In retrospect, we always know a year like that is possible. It wasn't something that's unbelievable, but it wasn't something that anyone out there in the investment landscape was expecting to have happen, especially with how bad the prior December and October had been. But it was a good year, and we'll take it when we can get it. 2018 was a poor year in the market and for this portfolio. But as we look back at any one single year or 12-month period, of course, we're going to see something aberrational one way or the other as compared to averages. One thing that probably is not aberrational and probably will continue in the future is the level of volatility we've seen over this period. Really, since 2018 and on, the level of volatility in the market has been higher than what we saw in the prior few years, but it's a really long-term and normal rate of volatility. Now, over the last 10 years, the rate of return has been really strong in the market, and I don't think there's anybody out there expecting the next 10 years to be as good as the prior 10 years. And it'd be really shocking to hear anybody say 2020 was going to be as good as 2019. Definitely possible, but a lot has to happen to make that be the case. So, of course, everyone out there in the investment landscape is trying to get in front of clients saying, 2018 was great, we love to have it. Don't expect that's the future going forward. The market's not pricing that. We look to the market. We don't make forecasts ourselves. We look to what the market is pricing in. And right now the market's pricing in much more muted returns, much lower returns, probably more for global equities like 6% per year on average for 10 years, and more like 2.5% in U.S. fixed income over the next 10 years. Again, no one year will probably be like that. Many will be above, some will be below. There's a snapshot of how the account was invested on pages 12 and 13. That's going to be very similar to what we saw earlier in the report. This is just as of the end of the year, December. We haven't made any major changes. There's just been market value changes since then. And then page 14 gets into the detail of performance and the history of the cash flows of the account. A few things to point out. At the top of the page, we begin at the most recent reported date and move backwards. You can see in the gain-loss column the $128,000 gained in December, a very good December. If we go down a little bit and contrast it with December of 2018, down $270,000. But another way to look at it that's interesting with the back and forth is to look at how good January was in 2019 as compared to that December. To look at May and June of last year. When we get this back and forth in the markets, it is really, again, a normal level of volatility. It's never extremely pleasant when it's going on, especially when we get the negative side of that. But it's what we get paid for as investors, is that volatility and that risk taking for sure. The next section is just our market overview. A lot of chart, absolutely.
On page 14, the net contributions and withdrawals here, you're now on track for smoothly transferring that money every month?
We are.
Mark,
Yes.
Mark,
Yeah.
can you speak into your microphone? They can't hear you.
Oh, I'm sorry, you're now on track to smoothly
We
send
do,
it?
so I think we've been doing that since September. There are 2 transfers, and those have occurred smoothly and no difficulties.
Yeah, what in 19, what is the September aberration?
The withdrawal of 109,000.
Yeah,
So,
Yeah,
I don't know.
that was a catch-up distribution on one of those funds that they designated and directed us to remit funds.
I got you. But now, every month you transfer a standard amount, percentage.
Right, so, yeah, a percentage. Yeah.
You're
So
not
one-
holding back anything, waiting for the city of Blackwell to call you to send the money. You send the money.
That's correct.
I got you, okay.
Right, that's
Only on
the
2 of the
general fund.
allocations.
On general fund
General
and
fund,
medical.
health account.
Just those 2 accounts are the ones that automatically fund the general fund and the medical or hospital. Those are the ones that are set up to automatically come in.
Without request by the city.
Yeah,
You mean out
otherwise we have to request,
of bank first?
yes,
Oh, so you have to request certain funds from bank first?
yes.
And the
We
other,
don't-
and CIBC
And
both.
CIBC, we don't get them automatically.
No,
We started getting
I
the
understand
general.
on CIBC, but I thought on bank first, you don't wait on requests, you actually send it out. That's not
Only
accurate.
the 2.
There are 2 funds.
2 allocations of the
We have a
citizen.
standing order to remit, and we do that monthly.
Otherwise, we don't.
Yeah,
unless
that's set
we
out,
need
that's
it.
set out in the trust indenture. We can't change it. The trust indenture provides for that. That city manager must request the funds other than the medical health fund and the general fund, 20% of the general fund. That's one of the things that we're wanting to address in this 3rd amendment.
Yeah. Funds automatically come instead of having to request.
Yes,
That's
that's
correct.
right.
Okay, yeah, I just kind of wondered where you guys were with respect to that, but I see that.
okay, all right. Turning to the market overview, I just have a few highlights here to point out, but again, happy to take any questions or dive deeper. One of the things would be, as we look forward into 2020 and really a longer-term perspective of 5 years and beyond, what do we find attractive in the market? Where are we repositioning or making any tactical changes? And as has become a theme for a long time, large U.S. stocks are fairly pricey, not necessarily overvalued, but they continue to look like they're at full value and yet continue to surprise us by going up in price. If you look at on page 19, chart 1-10, and I'll just explain what's really being depicted here and tell you as we look at this, this is just a glimpse into something that we're seeing, and I think a lot of people are seeing. We continue to see PE ratios in the U.S. market, which is depicted in blue there, to be fairly high and really elevated as compared to historical levels. Now, that can be okay because we're in a low interest rate environment, and that implies higher valuations, all else equal. So that by itself in a vacuum doesn't scare us, but as we look relatively at the other 2, the green and the red categories, we're looking at the international components, especially that red category, which is emerging market. Notice how cheaper earnings are being priced in the market in the emerging market space. So as we look at the landscape, We're more and more attracted to international stocks. We're also a little more attracted to small value stocks relative to our positioning right now. So you may see in the portfolio, or we may be reporting a year from now, that we've tactically dialed some of those categories up. We'll see. We try to make slow and deliberate motions in all of those areas. We continue to be value investors. Value has been outperformed by growth for some time. In fact, it's near record magnitudes and record lengths. So we are very ready for value to turn back in the investor's favor, and when it does, we'll participate in that a lot. So those elements of diversification haven't been working for us really recently, and we expect, though, over the long term they will. One other thing just to note, we have a number of charts on just about every topic you want, but if you turn to page 22, our latest economic and market quarterly, which is just a little synopsis that we do in our investment group every quarter to understand where we're looking at the U.S. economy, the bond market, the stock market, and what risk we see. Most of this has been very small changes quarter to quarter because not a lot of things have gone on to warrant big changes. We have done one little minor tweak on the risk category, and that is the second and third categories we swapped. It does seem that the trade tensions are being relieved a little bit, and that's a good sign. That's a good thing, all else equal. Geopolitical risk are probably a little bit more elevated now. War risk and things like that are a little bit more elevated. But our number one concern is that the Fed is not properly accommodative enough if we get into a slowdown. And of course, about a year ago, that was a very strong concern. And our expectation then was that recession risk was elevated and rising. And we really continued that thought process that recession risk was rising up and through the spring and into the early summer. The Fed, though, did change course and start to accommodate more, signaled that they were going to reduce interest rates, and in fact did so. And we viewed that as a really good thing. They came back and signaled that they don't want to reduce interest rates any further. In fact, would like to tighten interest rates potentially. The market is telling them something different, which is a repeat somewhat of what we heard last December and January. So the market right now is pricing in the expectation of one, if not two, rate cuts throughout the rest of the year. The Fed is a little standoffish there, so we'll see with that tension what actually plays out. And of course, economic data can change that landscape on both sides of it. But we continue to worry about recession risk and being dragged into a recession. We think that risk is elevated, but it's not nearly as high as it was over the last year at different points for sure. And we don't feel like it's rising. So that's a very high-level overview of that, but I'm happy to take any additional questions on the portfolio, investment strategy.
Anything? Questions or comments?
All right. Well, thank you very much.
Good job.
I just, thank you. Now that we've heard the two reports, we'll move on to item C, and that is discuss the proposed third amendment options to the Blackwell Public Trust indenture.
If I could start here, we'd first like to just thank this board for its continued assistance to the city and particularly to the hospital. You know, one of your own, whether you know this or not, was the one that put together the financing, and that's Mike Loftus for the hospital. It was a very, very difficult financing to get, and he added the benefit of $5.5 million in new market tax credit money, meaning that the city got effectively $5.5 million of free money that we're using not only to use on the hospital, but we're improving the 13th Street out here, which so desperately needs it. So, you know, the continuing assistance of this board has just proven so important. The reason I say that is you know, you guys took a risk. You know, you took a severe risk when you initially did the allocation of the money that allowed us to raise that $7 million to try to save our hospital. And we came to the place because, you know, the money had gone down. It cost a lot to run a hospital. It takes a lot to equip a hospital when you're starting from zero. And, the prospect that we had was that, the hospital could have closed and we'd have 8 more years, 7 more years to pay on that debt, which we would have been pretty red-faced coming back here and telling you, what we had done with your monthly income. But that didn't happen. We came out with a strategy for this new hospital, and I think this new hospital is quite frankly the envy of all the cities in this whole area. I mean, Blackwell is showing a future which is really setting the mark for small rural communities, in addition to the fact that Stillwater is coming over and operating it, and it's no longer on our nut. This money is no longer going to an operating fund. This money is going to a construction of a public building, as is your money, because your money was just going to pay off that note, which was being used as an operating fund. So neither the city nor the hospital authority has any more funds going to operation. We're only going to build this hospital, and it's Stillwater's baby for the next 7 years. So that's just a little update. I think you're due for it because of your contribution at the last meeting. I think we came and spoke to it. We told you what we were trying to get done, but in the meantime, we did in fact get that done. And thank you. Today we're presenting a third amendment. Normally I like to do cross out and underline. It's much simpler, but in Word, oftentimes it screws up the pagination of the paragraphs, and I wanted this to be something, if it was approved, that would be able to be immediately be able to be followed. But let me just very briefly tell you what we did, and I think that Mike did a good job of setting these out. I'm going to take you to the document real quick and just show you, because what we do is we've got the new provisions here on the front, and on the back end we've got them deleted. The old language is deleted. So what we did on page 1 and the top of page 2, we pretty much redefined community enhancement project and capital improvement project. We didn't make a lot of changes to it. We talked about what we were interested in doing. As part of this, we're eliminating sewer projects, water projects, and street projects, and we're combining all of that into capital improvement project. I think you can see that on Mike's page. I mean, that's one thing simply that we're doing. We're saying, let's call capital improvements, since water, sewer, streets are capital improvements, let's go ahead and eliminate those as 10% allocations, and let's put that all in the definition of capital improvement. Now, capital improvement includes community enhancement projects, and that's the way it is now. I mean, that's the way it is now. That's not a change. But what we did is we came in here and we, under the definition of community enhancement, we added a little bit of language, but somebody could argue, why is that necessary? It's really talking about where we'd like to spend that money. And some of the additional words there, really the old one stops with the word dilapidated structures and I'm on page 1, item A. And, we added beautification projects, property acquisition, remodeling, renovation projects, and then we listed some examples. So that's really in the definition sections. That's what we did to A and B. We eliminated water projects, sewer projects, and street projects because what we're talking about doing is funding all that money into capital improvement now. So instead of it getting 44%, it would get 74%. So that's really 2.2. When you get to 2.3, you can turn to page 6 and see what we deleted. And what I deleted is all these funds set up over in these investors' accounts. I mean, I personally didn't see, and I don't think Janet saw any reason that be separated into separate funds over there. I think the importance of that is that those be placed in restricted accounts when it's being transferred over to the city to ensure that we only spend that money for the purpose for which it has been allocated. And, you know, maybe there's a reason to have separate funds in the, in the investor side, or the two entities that are holding that money. And I suppose that's important if they get to continue to hold that and then wait on the city manager to requisition that. Because quite frankly, under your current trust, that the manager could just send a letter and say, I request that you send all the money and all the accounts to us every month. But we didn't think that was really keeping faith with you guys, because this was set up in a manner. And there's the whole issue about being able to invest the money at a higher rate over there than back in, back in the city side. And we wanted to give you the opportunity to consider that. But under the existing trust, the manager could say, under your existing trust, just send the money over. Just send the money, when it's there, send it over. We felt that should be addressed by a trust amendment, even though it could technically be addressed by an administrative action under your existing trust indenture. So what did I do in 2.3? Well, I eliminated all of those funds over in the investor side. They don't have to set up those funds. What they do have to do, let's look at 2.4. 2.4 is when we kept, the 20% for the general fund. That's the way it is now. We eliminated private projects. The last time I think we did an amendment, we dropped that to 1%. And we thought, why have a fund with 1%? Let's just transfer that to community enhancement projects. So community enhancement went from 5 to 6. And then capital improvement project, that's where we eliminated water, sewer, and streets and said, let's put that into capital improvements. And so the city can decide, what do we really need? We've done sewer. We've got the premier sewer plant right now, and we've spent $7 million, $8 million, and we spent
12.
We spent a lot of millions. That much?
Just on the plan.
Okay, just on the plan. And so, that may not be as significant for the city right now as a project. I think that the council would agree, the members that are here, that it's water lines, brown water and the like that is important. To cure, and many other things. But give us the flexibility. And of course, if you don't transfer all those into capital improvements, then I suppose we may have a sewer fund grow that we have may have a more limited use. I mean, we can always replace our sewer lines. There's no doubt about that. But give us a little flexibility. So what's I'm going to come back to number 3. If you're looking at the one that's bold-faced and underlined, we really gave you 2 versions. So let me come back to that. The original version has what I'm discussing now, and then we'll come back to the bold-faced part. So under 2.3, we eliminated all those funds out in the investor houses. At 2.4, we did a little bit of reallocation and eliminated sewer, water, and street, and put those all in capital projects. And then we have 2.5. And what we're providing there is that funds allocated to the general fund are immediately sent and placed to the general fund to the beneficiary. And I think this paragraph, at least I believe, is written a little bit better than what we had. And then funds allocated to the community enhancement shall be, and all these funds will be immediately sent. Now, I haven't addressed in here balances, but my intent is that it would include the balances too, okay? And so I made a note here as I went through on 2.5, funds allocated pursuant to 2.4 shall be immediately distributed each month. I suppose I could put there, if it's our intent, together with any balance in that account. I would offer up here that language if that's in fact, what the BPT would be willing to do, because there is the issue of the balance to course, the manager under the existing trust could order that to be sent anyways, but we're asking for permission. So each month, the balance, I guess initially, plus each month, that money would just be sent over to us, and it would be sent into a special account and not a fund, because Frank Crawford's here. Funds have to be separately accounted for, correct? Cost more accounting fees. And accounts can be used as, they can be restricted, and they don't require separate accounting. I mean, you do account for them, but it's just more to do a fund. And so they get sent over and they're restricted and have to be used for that purpose. And that is the end of this amendment. 2.6 through 2.13 are all the same. That's what you've got. So, and we can come back to 3 in a second. Frank, why don't you take it from there?
Well, sure. I'm not sure I can add a whole lot to it. First of all, for those of you that don't know me, my name is Frank Crawford. I'm the president of a CPA firm called Crawford & Associates. Based in Oklahoma City, we've been in existence for 36 years in a very narrow market niche where we only serve governmental entities. So I've literally seen every Title 60 public trust that could exist, including yours, hundreds of cities, towns, 11 international governments, U.S. federal agencies. We literally have just a broad-based practice. However, I'm kind of catching up on Blackwell. I've only been here in practice for 6 to 8 months, familiarizing myself with what's going on. And let me first echo Bryce's appreciation of what it is you do as trustees. I don't know if you understand the rarity of the existence of the type of trust that you manage, but it does not exist in many places. There are not many local governments that have a source of funds that are provided to them via a trust such as yours. And so I know the city appreciates every dollar that it does receive, and it's my job to make sure that those dollars are used appropriately. All I may add to what Bryce has basically said is we're kind of in the process in this first year of downsizing the complexity of the financial entity of the city. Right now it's like one pair of pants that's got 35 pockets, meaning that I've got 35 income statements, 35 balance sheets, all with balances that look like separate entities, except they're not really separate. In fact, most of them are all in one bank account. They're just pooled accounts where we share that money. This BPT adds a little bit layer of complexity in that there's 7 more allocations or 7 more funds held at the trustee banks that have definitive purposes as we've defined: medical, water, sewer, streets, private purpose, community enhancement, general fund. We've rattled them all off. Part of the reducing the complexity of the city is part of this process also. Instead of 7 allocations, we would like to combine that to 3. Yet still enable the flexibility of the city to assign from a priority basis which of those projects are a priority that we need to address now or we need to address next. As Bryce said, if all the money's locked up in sewer and we already took care of sewer, there's a lot of money sitting there in sewer capital improvements that we can't really use for sewer capital when we've got gigantic water line issues staring us in the face. That would allow a little bit more flexibility to let the city council and the city manager dictate how those funds are to be used on a broad perspective of capital improvements. So that's really all you're seeing is water, sewer, streets combined with capital improvements and the private projects going in. That's the main issue related to the amendment. The only other thing I saw, and as Bryce has alluded to, that I think has a bearing financially is the trustee banks and representatives of both banks have expressed their desire to not have to do the allocation accounting anymore. In other words, every month we are allocated a percentage portion, 7 different allocations. Some of them come automatically, like the general fund and the hospital. Some have to be requested by the manager for that particular purpose. It appears that CIBC has changed their methodology a little bit, because although I wasn't here at this time last year, I think I remember there was no separate pullout of that 3 million that we're talking about at CIBC. 48 million in total, 45 million locked up in all of their funds, and 3 million, if I understood correctly, on money market at 1.7%. What I think this amendment would call for would be that 3 million is going to come to the city and be allocated based on this new percentage that you see in the trust indenture. And then it will be the city's point to track that money for its purpose from that point forward, rather than the trustee banks waiting for us to send a request to them. And then once we send that request, they have no idea what we're doing with the money anyway. They just cut the check. So it still drops into the city's function. If I'm understanding the amendments correctly, basically, as that money gets allocated, it's coming, which means not only monthly, but that big 3 million that's going to be a catch-up for all the money that the city could have requested over the last decade that they did not. And then would then be split via this allocation that's in this proposed indenture. So those are really the two big things that I'm seeing. But I do have, and again, I'm speaking from total ignorance here because of my unfamiliarity with the city other than the last 6 to 8 months. Is there an end game with this trust? I know what it's for. I know how it was created. I understand the mechanics behind it. I saw what went in initially. I've seen what you've done with the trust and the amendments, but I get a number of questions via citizens at council meetings or on Facebook posts in the community forums about what that money is going to be used for. And I know right now we're reinvesting some of it into itself to grow the principal, and then allocating certain percentages both to the city and the hospital. But at what point is there an end game, or is there a goal? Is it 80 million, and then we're going to use 20 of the 80 to do something, or has that not been addressed, or perhaps there is no end game? I've just had numerous citizens post or ask these questions about what that money ultimately will be used for. And right now I know it's generating investment income for the various functions of the city and the hospital, but is there something else? Is there some goal, some end game to this process? Because that's the question that you're going to get in more detail as more people become aware of the trust's existence and what it's there for. And again, I'm not advocating that we do this. I'm just advocating that maybe there's something there that I'm unaware of that maybe would be beneficial for me to know, so that if I get asked, it's something that I can answer at these council meetings and in online forums that I happen to see. So that's really it. I don't really have anything more to add to Bryce's explanation, but no matter what you do, accounting-wise, we can account for it. It's not there are a number of different ways, whether we set up separate bank accounts to track this money, whether we set up a separate fund, whether we set up a sub-account within a fund. The tracking is not the issue. That's probably one of the more simple things. The issue is basically the mechanics of getting this fund and getting the money that is already the city's to the city. Once it's here, I think the accounting side will be the easier part of it. So I don't know if you have any specific questions of me or accounting or finance or city stuff, but that's really all I was hoping to learn more from you guys today than what I already know about the trust from what I've read and caught up on. So
I think I'd like to pop in here because I I'm always accused of talking too much, but I want to get all of the explanation out because there were a couple other things in here under the definitions. We also added as a purpose under these two capital improvement project and community enhancement project, the ability to use the money to pay the payment of principal and interest on bonds, notes, and other evidences of indebtedness to the extent that we needed to go out. We thought that that language probably ought to be there in case we took that money for a project. Just like is being done under the medical allocation. The other thing that we added, which I don't know that we needed to add, I suppose we did need to add here at capital improvement. It's not meant to hide the ball, but we added electric project, okay? And one of the reasons for that, and I wasn't here when you originally set this up, but your electric distribution system, parts of it are you know, I've said it before, it's like a dinosaur. It's really old. You have different voltages on different lines, and it needs to all be brought up to a standard. Now that would take a long, you know, period of time and real planning, but other than this trust, our moneymaker here is the electric system, and that's the moneymaker of every city that I represent. I represent, heck, a quarter of the OMPA cities, Oklahoma Municipal Power Authority cities, a bunch of them, and it's the moneymaker, other than the money that you send, and investment in that utility is critical. Now, we could do it, I believe, under the definition of community enhancement, because it says projects other than those listed, so you could probably do it, but I just wanted it to be clear. I wanted to put that issue out here too. I wanted to make sure I wanted to first make sure that you didn't think I was sneaking around there, but I did add that, yes.
Comment, couldn't you do that under capital improvement also?
Yes.
The electric, I mean, that makes sense.
Yes.
Yeah, you probably could, but I still, you know, on these issues, I just wanted to bring those issues to let you know what we're thinking about. And if you want to go back, because we might as well, you know, go back to the bold-faced underlined dollars. And we don't want to be the group that comes here and duns you all the time, you know, because that's what we've been. Come before you and dun you for more dollars. You know, maybe this ties into Frank's comments. You know, I understand the purpose of this trust. You're growing money, you're doing allocations. If the market falls, I mean, you know, there could be all kinds of things. However, the public, you know, we come here twice a month, and the public is screaming, you know, for streets, you know, roads, projects, economic development, and the like. So what we put in here was a please, won't you consider it? I put in 1/16 of 1%. I limited it to a specific period of time. I think it would raise $350,000 or so, given the way things are per year, close to $1 million, and what we were talking about over.
Yeah, it would fluctuate between anywhere from $750,000 to $1 million. I mean, it could be 250.
Over the 3 years.
Yeah, over the 3 years. It seemed like 1/16 of 1% based on just 50 million, even though I know there's 54 million roughly in there.
I guess to tell you what's the benefit, well, one of the benefits is the Blackwell Public Trust could, you know, say, see, we're doing more. You know, I mean, I understand the public's comments, but we're still doing more, and it's not a lot. I mean, it's not a whole lot. Heck, I thought we were gonna have to come and ask for a major allocation for this hospital, right, Mike? I mean, I know you weren't gonna let me, but we were there when we were talking about financing and all, and we were able to do it within the limits. So, you know, I suppose that just, you know, it ties into kind of Frank's comment. You know, it would allow the trust to say, okay, the city came and asked for this, it's only gonna have that kind of impact. It's gonna run for 3 years, you get a 3-year respite from us, coming and asking for more dollars, because this would be it during that period. And maybe if you can accept that at that level, but maybe you can't, because, you know, you want the income to grow. Of course, like they've said, a market adjustment could remove, 5 million of this or even more, and then we'll be wishing that we had taken some, but you guys are the investors, you guys are the guys to make those decisions. That is the amendment that we're bringing before you when we brought you to option 1, and option 2 doesn't have that language in there. We'd like option 1 just to, clear up the accounting and allow us to do our jobs, not have the 35 pockets, as Frank says, clear up this issue, and we've asked for this additional thing as a, talking to our great uncle about, about helping us, Anyway.
I'd like to address part of this, just kind of pick it a little bit here. A discussion about merging some of these accounts have been talked about off and on since I've come onto this trust. I think it's a good idea. This gives the city a little bit more flexibility on how they use their money, if it's accounted for. I think it's a good idea to put that, the comment about the electric system in here. That's my background. That's where you get your money. I think it should be in there. I don't know why it never was, but that's beside the point. And I could see you could use that under the capital improvement or the community enhancement, I guess, if you want to go that far. It makes sense to me to combine those numbers to that 74%. And as far as how the money gets to the city, makes it easier on our investors to do that. I think that's a wise decision to do also. We need to do that, in my opinion. I have no problem with that on those points. As far as the other points that you brought up about the new, I guess, the addition to this, I'm not sure that I would be in favor of the community enhancement part. I don't know exactly, I know what those funds are, but I don't know what all that goes to. Right now, as you say, you've got people streaming about water and roads.
We would be happy to put it in either project account. So, I mean, if we're making sausage here, we would be happy to change that, that designation.
Of course, it's not my role as far as to tell you what you have to spend your money on. I mean, that's not
I know.
That's not my purpose here. It's just as a citizen, I guess you might say. I think, to me, part of this, I mean, I know to begin with, all this money was, we wanted to pass, the original board, wanted to make sure this money was invested and where we could, I guess you might say, get a large sum of money and then start passing it out. And for whatever reason, the city never asked for anything until I got on the trust. I think that was the first year they asked for anything. But now we're at a point where we can spend some of this and do it hopefully wisely. Part of the problem I've always seen was no plan, just money, no plan. I've had that problem with this past, in the past. Good, bad, or ugly, that's just my opinion.
Tell you what, I would be interested in, I wasn't seated on this board when it started, but I would be interested in the thinking as to why it was all separated. And instead of a lump sum as being suggested now. Can you guys address that? As to what?
When I got on the board, he was there.
Well, I'm not sure why it was on there, but I think now is the time to fix it, and whatever's money left over in those little buckets, we can put it into where it should be. I don't think that's gonna be a problem.
I
Past
can
is
make
past.
David, I can make a couple of comments if that's so desired.
Could you
Mark.
come up to the microphone?
Mark and Mike were on the they were original trustees too. I feel like our intent was to make this perpetual, number one. And as far as the buckets and things like that, the different categories was, I think it provided for me discipline and the integrity of the trust. And it's still very important to me to keep the integrity of the trust intact in a perpetual way. But yes, look what it's done. And please don't take advantage of it, because we're gonna have a turnover in these trustees, we're gonna have turnover in the council. And I understand citizens wanna see some of the money spent. But we have a tremendous amount of responsibility to make sure it's intact for generations to come. And there again, back to the buckets for the different accounts, for me, it provided discipline. I can see the electric argument, I can see a lot of arguments. My concern is that if you put it more in a pile, you're gonna spend it. You're gonna spend it every year. So it takes proper planning. And we're talking about a lot of dollars. So that's basically how I saw it 10 years ago. And I think the two groups that are investing your money have done a very good job. I'm proud that we were able to put the trust together, protect it, and the community can benefit for many years to come.
Thank you, Brad. Some of those same statements of what I had already thought when I saw the two proposals was to protect it, as I said, so you don't crack the egg open anymore, so you don't get any more out of it than what we already have. But I see the project bucket staying separate in a way, as Brad said, for discipline, because it still allocates money to water, to sewer, and to the streets, where, as Frank's even said, he hears, wherever he hears this, people talking about it, reading this, that people want various projects done. They don't just want one project, there's other things. So if you throw it into one bucket, you could be set forth for the future into, for however long, of just doing just streets, or just water, or just sewer, or any capital improvement. You can throw a lot of stuff under capital improvement. Now, if you leave it into these individual buckets, and granted, these individual buckets only have 10% each. Capital improvement still has 44% out there by itself. So there's still a chunk, and you can tie these, the capital improvement money yearly with the street, or with the sewer, or with water, to do those bigger projects. There's over $13 million that has been used out of the public trust money, the interest money that cities receive, that they have actually used on projects, with about $3 million still sitting in there. Now, as Frank mentioned too at our budget meeting, he said we shouldn't be hoarding money, but then went on to say that we should have a cushion. And when asked about how much, wasn't for sure, but typically they like to say about 3 to 6 months. And with the CDs that we have, and counting this public trust money, we've only got a little over 2 months worth of cushion. So that, when you start really spending everything down that you do have, you have to be careful not to get yourself in a bind.
Well, I think that's a good point. I think it's a real good point. And the city council could take that money in the capital improvement project account, restricted account, and could divide that into streets, sewer, water. The question is, why should this entity? That's the question. Why should this entity, which is investing the dollars, right, and doing the returns back to the city for us to do, why should you be that
Well, I think Brad mentioned
intertwined?
that already answered your question, though. It's for discipline.
Well,
Because that's kind of like,
I think the
I just
discipline
want to add at
may
the
be.
beginning, that's how I felt, but look
Right.
how it's grown.
right.
I can understand your concerns, and I would look at it equally.
Yeah,
It still takes discipline. Moving
I think
forward.
the discipline is holding on to the principle. At least that's what I would offer. The
Well,
city
ultimately, you'll still have, as the council, control over what that money gets spent in, if it's in 7 allocations, or 7 funds, or 3 funds. In other words, that annual budget process is where you're able to say, okay, I see we have 3 million in, of total trust dollars at our disposal. 2.5 million of that is related to capital improvements. Here's the priority that the council would like to see. We'd like to spend 500,000 on streets, 100,000 on water, 200,000 on this, and so on. So ultimately, you'll still have the discipline via the annual budget process as the city council to dictate it. It just wouldn't be this body that dictates you must spend X amount on streets, X amount on water, X amount on so on and so forth. So, again, the accounting is not the deciding factor here. Don't let the accounting sway any of your decision. You'll have control over the plan, whether it be an annual plan or a 5-year long-term capital plan or a 3-year plan. The city council will have that authority to decide via how that money is going to be spent, whether it's in one bucket, one allocation, 3 allocations, or 7 or 8 allocations. It's just from an accounting perspective, it's much easier to count for 3 things than it is for 8.
That's my point also, is there's gotta be accountability on the city council side. Now, I mean, if we decide to, change these funds and what buckets they're put into, you guys are gonna be, the city council's gonna be the ones that are, report to the citizens. It's not us. We're not here to be the political body of this city. It's the city council. And hopefully, this gives you guys a little bit of a room to, okay, I've got to stop halfway in on this, I've got to stop in the middle of this block because I can't finish out this project on the water or the roads. This gives you a little bit, or the electric system. This gives you a little, hopefully you look at this and say, of all this 74% of the money, we're going to spend a little bit here, a little bit here, and then you have a little bit of a cushion to kind of make up for some of those projects. We've got to hopefully have a little trust there, and these citizens twice a month are going to see what you're doing. So I'm just in favor of giving you a little bit more of the rope to hang yourself or make you look like heroes. I don't know, my opinion.
My opinion is this, I have concerns. I have concerns because the city has not established any long-range goals. Frank's talking about we can do this, we can do that. We can, but the city has not established long-range goals, so the citizens could see, where are we going? Where are we going to spend these monies? Okay? We know we need water line distribution. We know we just had a DEQ report says our water plant has deficiencies, needs attention. Obviously, we need streets, but the city council has not established any of those long-range goals. We have not, and as TJ's just commenting, we don't have a savings account, so to speak.
Well, let me clarify one thing too about that. This 3 million, I don't want you thinking in your mind that this is your cushion, this is your reserve, because it's not. If the general fund runs out of money because it paid too many people salaries and wages, it's not like you go over to this fund and grab a couple $1 million and reimburse the general fund. That can't happen. This money isn't really part of an operational reserve because it's not operating use money. It's only capital. It's only stuff that has some community enhancement benefit or has a capital project benefit, and then the only part of it is that 20% allocation to the general fund that's really used for operations. And so you really, there is a 20% part of it. And that 20%'s been taken. In other words, the general fund has now received all of its back money from both the trustees, so that all you're talking about, the general fund allocation, is what it earns every month, comes into the general fund now on an automatic basis. But the large bulk of this trust is not there for a rainy day. It's there for a project or a capital. It can't be used as a reserve. So that probably defeats the point you're making about, it supports the point you're making about we need more reserves. And I'm gonna tell you, yes, we ultimately need more reserve money, but we can't count this as much as I'd like to.
Right.
Because this is dedicated, restricted solely for capital project money and can't be used, even if we run completely out of money everywhere else. So, don't think of it as an operational reserve, but think of it as an untapped resource that you have a right to tap if you can develop a use for that money, either both short-term and long-term.
Well, it's definitely been tapped, like I said, to the tune of $13 million over 10 years.
Absolutely, and most of that
It's
13
been
million,
tapped pretty,
most of that
it's almost
13 million has
been left.
turned itself into a project.
Right.
You can
Right.
go back for
And it's
inception
also,
to look at.
it's also paying for sewer plan, it's also doing some other stuff. So
Absolutely.
it's being utilized pretty well. We are seeing a return, citizen-wise, out of this.
Well, the fact that you've been able to double the size of the trust, yet still pull 11 to 12 to 13 million out of it, makes no mathematical sense to me. I know I see it, I understand it, I know it's happened, but that's so rare.
I'd like to speak from the standpoint of being here since the inception of this trust. The way this was set up was to, as Brad alluded to be in perpetuity, a cash flow to the city for certain purposes. It was not, about 20% of it is designed to go to the general fund, and it does, and that's walking around money for the city to spend on the, regular budget stuff. The other 80% that's been allocated out in different areas, just exactly how that was. Let's double back to when we started. The theory behind what we're doing was to distribute enough money to the city to have enough money that was remaining in the trust for it to grow for inflation over a period of time, and that allocation of 3% a year that's going to the city for various functions would continue to grow. Now, when we came out the first year that this did distributions to the city, it was around $900,000 a year. It's now around $1.3 million to $1.4 million. We've added another 2% that we've taken out, and we were designed to invest based on having a return, a split between equities and bonds of on average about 6% a year. We've outperformed that by 2 full points over the last 10 years. And I contend that this has been kind of an aberration. We went into the market in 2010, right after the financial crisis and everything, and we caught the upswing of that, and we're very, very fortunate. So you got the equivalent of coming into the city every year of another 3%, 3.5% sales tax that is not going, not being charged to the people. And it's getting to be larger and larger because of the defense mechanisms that were built into the trust to begin with. We added on 2 points to pay for the hospital, and Bryce and I got into it pretty hard about, thinking, I thought taking 2% more out was too much. But we ended up agreeing on that because that was so important to the community that we preserved the hospital. So we're sitting there, we're still doing what we're doing. We have historically grown a little bit more than what we're taking out, and we're having the ability to deliver a growing amount of money to the city every year. My point of view about how the buckets are divided up and all that kind of stuff, I think that was, put that, as Brad said, a discipline piece in the beginning, but, what those funds are to be used for are capital in nature and not general operations. We allocated 20% to general operations, so, you know, the city needs lived inside of its means for general operations based on sales tax, electric revenue, and this 20% that comes off of the trust. The balance of it, I don't have a, you know, problem one way or another about putting those funds together or not putting them together, because the definitions, you know, water project and capital improvements can be pulled from either fund. You know, water's water, but capital improvements can be water, or they can be sewer, they can be street. So it's kind of semantical. That, from a discipline point of view, the public elects the city council, and they make those kind of decisions. How that is done is the city council's purview. Our job as trustees is to preserve this fund, invest it properly, which I think you've seen historically that we've done a really good job of it, that we have grown it. Now, you asked Frank what the end game was. The end game is the trust document. The document says what we can do as trustees, and it doesn't say anything about an end game. So the end game is to invest this trust, to distribute to the city for the purposes that the trust document says, and that's what we're doing here. We're not sitting there going, okay, at a certain day, we're gonna grow to a certain amount, we're just gonna throw a big bunch of money out and, to, you know, do whatever with. But what we've done as a trust is we've allocated these funds to the city, most notably for healthcare and for, the sewer plant. There's two large financings that are made based on the cash flows off of this trust. And those cash flows have to remain intact in order for us to, you know, for the city, not this trust, for the city to not be in violation of their covenants on the financial arrangements that they made to build this hospital or to redo the sewer plant or buy a fire truck or whatever else that gets done to take a cash flow and say we're going to commit this cash flow over the next 5 years to pay for water improvements or street improvements or something like that. That happens on the city council side, and that's not the job of this trust. We are to do what we're supposed to do to make sure that these funds are available, and we've been awfully fortunate that we've just lived in a period of time that it's done extremely well. You know, you could move this 10-year window sideways, backwards, and have some results that are a hell of a lot different than what has come out. You know, on average, 8% plus on average over a 10-year period. That is abnormal. It should be about 6. You know, historically you can go back to World War II and run that deal over any 10-year window you want to look at, and about 6 is where you would hit, and taking out 3 and accounting for inflation, well, we didn't know inflation was going to be nominal. You know, inflation historically has been 3%, so we're looking at 1.5. So we're continuing to augment the city with a better cash flow every year as a result of how we're doing it. You know, how we do these buckets and all that does not concern me personally all that much. You know, we have 5 people up here as trustees. You know, 4 out of 5 of us got a agree to this if we're going to amend, the trust. So I look at it from, you know, what kind of things that we have here that we can agree to, and what kind of things that we're gonna not be able to agree to, but what kind of things that we can put forward, in this potential third amendment to the trust that improves the situation and makes it easier to function. And, I think the distribution of the funds directly to the city's accounts makes all the sense in the world. It should not be the job of the investment companies to segregate that. They can distribute it on a monthly basis. You guys account for it, properly, you know, you do it right and everything's cool, and you do it wrong, and, there's an election that will take care of some of that. There's a little provision in there about, the planning commission needing to be involved in a private project. I think that's redundant. There's already, the planning commission would be involved anyhow if it was a new construction deal, but if it was painting the front of a building or putting up an awning or something like that, they should not have to be involved in that. Whether this board wants to combine these things into one big number for capital improvements or not, I think you still can get to the same spot. But you have some, you know, have some restriction by those 3 10% amounts. I don't see any problem with combining the private projects and the community enhancement into one fund. I would be concerned about taking any additional money out for this 1/16 of 1% deal. I think we've stretched ourselves as far as we ought to go, and but that's one man's opinion. So that's the history of the world.
Mike, could you explain the 1% private projects when it was originated? The idea behind that, I don't believe there's, you know, just a question. Again, why would it get set up as, you know, 1% going out, but it was more than that.
Yeah, it was 5% originally.
And it was adjusted to 1%.
Because that was not being used, and there was no private projects that came forward that, anybody was willing to do, so it was amended in, I can't remember whether it's a first or second amendment to the trust, down to a lower number.
I'm still confused, Frank, maybe you can help me out here. I'm still confused that if we got 7 buckets, and money comes out, well, it's easy to solve the distribution of the money to the city. It comes out and goes into those buckets.
The city will have the buckets rather than the trust.
You know, I understand, and it's into those buckets, and one bucket starts getting bigger than the other because it's not being used. I'm confused as to, can you trade money from one bucket to the other?
I don't believe that the city or the city council can alter the trust designation. In other words, if.
I'm not talking about that.
Okay. He's talking about mainly just the city being disciplined in themselves and staying within that bucket guidelines. Because
Well, if you have a water bucket.
No, that's not what I'm talking about. I'm talking about if you got a sewer bucket that's built up and a water bucket that's built up.
Could you transfer some of the sewer bucket to water?
Right.
As far as I understand, no.
No.
Not right now, because that would defeat your trust indenture as it's currently written.
Okay, now I was thinking, like you were saying, that we could, that the city could.
Only if it's.
You could use buckets in conjunction with one another.
If you wanted to finance a water project and you used the cash flow from the 10%.
Of water.
And some out of the capital improvements, together to be able to finance a water
You
project.
can satisfy your water project needs that way.
Correct,
Yes.
correct, but you would not be able to take from another designated
But you
allocation
cannot-
and just say,
you
we're not gonna
cannot
use
go to
that money for
streets
sewer.
and pull that money out and use it for,
Water.
water or sewer.
Well, what
Or
does the
other
city,
capital improvements.
what does the city think, in terms of, its needs? I understand are bigger for the water area. Is there enough coming to the water area to finance a project, a water project?
Do you want to answer that? or-
You go ahead.
Well, you know, with these allocations, we have to keep exactly what you've done, 10% on water, 10% sewer, 10% streets.
I understand.
And so what we're asking to do is, can we just put it all together, all 30%?
No, I
Just for
understand.
capital approved, because then when it comes to me, I can say, this month I've got a bigger water issue than I have sewer or streets. Can I spend out of this? And the answer would be yes.
That, I understand.
I think the
that.
city would like the flexibility to not spend just the water allocation and some of the capital improvement allocation on it, on the water project, but also use some of the sewer or some of the streets if it's not needed for that
Yeah.
at that moment. But right now, they can't do that.
Are you asking to change the indenture to that fact? Is that
I
what
think,
it
the-
is?
yes, I think the indenture is to consolidate
Yes.
the 7 buckets down to 3.
Condense.
A general fund, a
Will give
community
the city
enhancement.
more flexibility. to
Correct.
operate.
Yes.
It would give the city the ability to say, you know what, my sewer needs are not that great, but man, sewer sure has a lot of cash in it. We could sure use that in the streets, which you can't do that right now. You could only use the street bucket and the capital improvement bucket to satisfy
I hear you.
streets.
What puzzles me a bit is, if the money is in the water bucket, one way of using that money is just spending the cash and fixing the water problem.
Correct.
Another way of fixing the water problem is financing a bond issue
Correct.
with that cash flow stream.
Correct.
That's the other way that we're wanting to do this, is to have the opportunity that we've got a larger amount of money that says capital improvements, that we can tap for things like that.
Yeah.
And, you know, for instance, we spend, what's our sewer monthly, 80,000, and we only
We
have.
draw 53,000, I believe, from the trust for sewer every month.
And that automatically goes to the wastewater
Debt payment.
treatment plant, debt payment, but we have to subsidize more from another, account, because that's not enough to make that payment every month.
See,
Okay.
that's confusing, subsidizing
Yeah.
from another account. I thought
We
you could-
pull money from a different place, because although that, we're using every dime for sewer.
All of the sewer,
All of
all of
that.
the sewer allocation is
Where
going
do you
towards
get
sewer,
that?
and then some of the capital
I
improvement.
thought
funds
you
go
said
towards
you
that.
couldn't trade between
Oh,
these
we're not
accounts.
trading.
It's not
If it's
a
within the
big
same
thing.
purpose, sewer and
It's
capital
not-
improvements are the
Oh, I
same
see,
thing.
I see.
I can't go from street to sewer,
Yeah.
or sewer
I
to
see.
water, but I can go part sewer, all of sewer, and part of capital improvement. It's just, there's just 7 buckets,
Yeah.
which you can combine one bucket with some of the others, but not all of the buckets together.
Brett, I guess I was on this thing from the start, right?
Yes, you were.
Okay, I'm sorry, let me get that correct, but let me,
You can't get out of that one.
Yeah, I can't doubt it. Again, I go back to what both these gentlemen saying, it's not our place to say what the city, how it spends its money, right? And certainly if the city has problems with the way the indenture's sitting there, we can make adjustments, I would think, that would make their job easier. One of the adjustments we're making is to make a job easier for CIBC and Bank First, is to let them wire one amount down.
Correct.
You guys worry about the accounting, but you also said something about, this is certainly gonna, if we combine these accounts, you're gonna give the city rope to hang themselves here.
Or to be
Or to
very
be-
successful.
Or very successful.
That's correct.
Uh,
And that's just, I mean, you gave them enough rope to hang themselves now. They would just hang from a shorter distance.
Yeah.
Because of the depth of the buckets.
With the value of the trust today, you got every year $1,650,000 coming out,
Yeah.
the 3%. You got another $1,000,001 coming out, to go to the hospital. So a total of $2,750,000.
Correct.
But that's what it is today at a level of $55 million in the
That's right.
trust. And like Mike was saying, that thing could go south on us in a hurry.
It could.
Those numbers will go south.
And the flip side of that is going to be if there's a 30% market correction, let's say, bottom drops out, we lose 15 million in value. So instead of 55 million, we drop down to 40.
Right.
I think you'll hear the reverse of why didn't we spend the 50 when we had it?
Oh, yeah.
I mean, in other words, you're going to be darned if you do and darned if you don't, unless the market just continues doing what it's done.
Someday
The
it'd be awful nice
situation
to have
is,
100 million.
Absolutely, generating 4 or 5 million.
Then we wouldn't be as, have problems
Absolutely.
with
Yeah.
that.
We're
But I mean,
sitting up
it's-
here with a trust indenture that's gonna do what the trust indenture says, and our board is charged with carrying out what
Absolutely,
the trust indenture says.
absolutely.
And so,
And that's the distribution of not only the earnings, but if you decided to distribute principal, you could do that. I mean, there's nothing I've read in the trust that says this money, the principal must be held in perpetuity. I mean, I think that's a decision you've all made as a group. I don't think I saw where that money simply can't be spent, its principal can't ever be spent.
Well, it would require an amendment to the trust.
Okay, all right, maybe so.
Yeah.
Again,
I don't-
I'm learning
I
more
don't
than.
remember that clause as far as the principal being restricted, the
Okay.
original principal.
So
I don't
if there
remember.
had been a viable project.
But your conversation scares me that
I
we want to
understand.
spend a lot of money.
Oh,
Okay,
I'm not advocating.
I understand.
I just want to make sure I understand the trust indenture,
Well, Brad,
because preservation of principle is
But I
one
do
thing.
think we failed on the electric side, by not setting a fund up for it. And, I think it definitely needs to be included.
let's go
Can I
back
add
to
to that?
this.
The electric door's been open.
Yeah.
And I've raised my hand 4 or 5 times and nobody's addressed me.
You're not.
So I'm gonna interrupt everybody.
For those of you who don't know who I am, my name is Greg Sixkiller. I've been working for the city of Blackwell for 34 years in the electric department. I'm currently the supervisor. This trust indenture, as far as a little bucket that's for the capital improvements, electric's never been
That's
added
a
to this.
44% bucket, it's not little.
Well, a bucket,
It's not
let's just
little.
say,
That's a big chunk. Okay.
bad choice of words, let's just call it a bucket.
Yeah.
Electric's never been part of this. And Mr. Reeser, I'll allude to what Mr. Reeser said, and I've said this for a long time, that's our bread and butter, is electric department, other than sales tax revenue. But yet, we don't reinvest in our system. My position before you today is like with public trust, is to pass at least part of that indenture where the electric department can get a little bit of the kitty out of that. I certainly like our pie on that, bite of the pie. We've been unable to do a lot of projects because of, we've got a lot of needs. And a little bit of money coming out of that, other than general fund, where we have to budget every year, is not cutting it. And,
That's not, is it, that's not.
It's not prohibited at all. You can use part of that 44%, Greg.
well,
And maybe.
I've never heard electric department involved other than sewer,
It is
water,
not-
and streets
It
in
is
that
not a
bucket.
prohibited expense.
And so that's why I'm
Right.
here too.
So that 44% is wide open to electric upgrades.
You're talking about a council issue, not a
And-
public trust issue.
Yes,
Right.
yes.
Greg,
Well, way I understood it, that bucket only pertained, I never heard the electric department ever involved in that.
Right.
This is the first time it was
Yeah.
brought up was today. That's why I'm addressing. Yes, you're absolutely right, Mr. Webb, there is a council issue there.
Yes.
But I was trying to make sure that we can get a little piece of that pie, if that's what the trust indenture states, is just sewer, water, and streets. I'm standing before the trust saying, hey, let's add that electric in there. Let's think about the investment and the savings and efficiency we get out of our system
Yeah.
by that being put part of that trust indenture.
Yeah, I don't think.
But you all are telling me it's already in
I
there.
don't think
It's already-
anybody has a problem with
yeah.
that, either leaving it like it is and saying, well, it's
Yeah.
already in there,
It's
or
already
if
in
you
there.
wanna add electric, that's fine.
Yeah, I mean, if
Do
you
I
want to
understand?
specify, but I mean, it's capital improvement, so I mean, it's
Right.
anything capital, fire truck, ambulance, anything, police vehicles, I mean, any of those things, any capital improvement, any kind of building improvement.
Yes, Brad, a question about, hey, Brad,
Yes, sir.
let me ask you, let's go back on this discipline issue. And I can appreciate that. On the other hand, I can appreciate the constraints that that kind of thing might be making. Do you have a problem with,
I don't have a problem with the change at all.
what you mean with accumulation down
I
to
don't have
three
a problem,
accounts?
I don't have a problem with it. For some reason, we just left electric out. I think Greg's point is, he just doesn't want to be short-sighted. He wants to be created equal. It's one of the most important departments in our city, and I think that's the direction he's coming from. It's real simple. Throw him in there, alter it, whatever needs to be done.
I'll just make a real quick comment since we're on electric. You're missing the boat if you don't take care of your system, because your line loss is killing you.
That's why I have a
easy.
generator in my
That's
own
easy,
trusted
that's
system.
easy to see. And that will, I know this from experience, because we rebuilt our system, the company that I work for, and there was a vast difference with that. Now, and I understand you can't change it overnight. It took a long time for us to do it. But changing out wire size, changing out voltage, you can help yourself tremendously.
Tree trimming?
Tree trimming, the whole works. But I'm just saying, there should be some of that money that goes to them, and that's just from the citizen side of it, not this trust, as far as I'm concerned. But you're missing the boat if you don't take care of your electric system.
Well, thanks for hearing me out. I appreciate it. Just want to be sure that we were included in that. I wasn't aware we were.
Yes, you're definitely in part of, fully available out of that 44%.
Thank you all.
Like, see some of that.
I got an idea that it presented that there's an excess amount being accumulated in any one bucket. I don't believe that's the case. I think we look at it, there is no excess being accumulated except perhaps in that private projects, okay? Because there hasn't been a request for that. All the rest of the buckets, I believe there's, nothing's excessive in any of those. And there's a question I put to Frank for the last meetings, and that was, and I believe the trust has benefited the city, and if we did not have the trust, we'd be in sad shape today. Talked with Max, when Max was on the board here, he said there was a time the city was having difficulties paying its bills. I don't believe the city today, without the trust, would still be able to pay its bills. And asking Frank, if we didn't have the trust today, what would you see? What would the changes be? Some of those changes would be, we would be eliminating what we tried to do a couple of years ago. Need to downsize, live within our means, because we're not living within our means. If we didn't have this trust money coming in, so the city can't survive on its own, on the revenue that's coming in from the electric and from sales. We're still upside down, correct, Frank? Like tune of $1.5 million.
I think your budget adopted to do that, but I don't think the results, so far the results of the year haven't proved that yet. We're still running in the black through 7 months. So although you had budgeted to spend $2.5 million more than you collected all funds together, we haven't done that. We're on the plus side, so we're not there. So unless things turn in the next 5 months, which I don't really anticipate them turning, I think your year is not going to be indicative of what you had planned. Rather than spending more money than you're going to bring in, I think you may actually bring more money in than you spend for this year. But again, we're 7 months into a year, so it's hard to predict what's going to happen. But so far so good. Like we were talking about at the other council, we're nowhere on pace to spend $2.5 million more than we collect. But you're correct. Your point. Without that trust feeding 1 million, 2 million, 1.2, 1.3, 1.5, we still would have spent 13 million on capital. But where would that 13 million have came from? General fund and BMA via even higher utility rates and maybe even another penny sales tax or or we would be broke, literally. So your point's exactly right, that trust is the equivalent, as Mike had said, a 3 or 4% sales tax rate. That we don't have to do anything or pass it on to anybody to get. So you do have it though, that's the beauty of the thing. So as long as you plan annually of how you're gonna utilize that money, that's kind of what we wanna do. We wanna watch the flow of the money in and the flow of the money out, and make sure we keep enough money to get us through a crisis or an emergency, and then the rest of that money ought to be going out to provide services to the citizens, of which the trust provides a gigantic slice via its contributions. So, anyway.
How do we get on track to figure out what we do?
I can help with that. Well, let's go back to Dave's point, and that is that number 3 that no one is really interested in except for Dave, maybe someone else is. And that's, he suggested changing that to capital improvements. I'll tell you, if you really wanted to do something, everybody has kind of pointed to it, and that is, we need to be making a steady investment into that electric system. I mean, you talk about priorities. I mean, we did buy a vehicle, okay? But it needs to be converted. Now, we converted another maroon town south of here, and I converted, how many different voltages do we have?
2400, 14.4, we got 2.
Okay.
This 14.4 is what we're trying to improve, or trying to upgrade to. The 2400 is a system that's going away everywhere, all over the place.
Yeah, and we can't get parts for it, and you've got folks that are retiring that are trained to that. The new ones aren't as much, and it's safety issues, right?
Yes.
So I mean, if you could see past, doing that capital improvement / electric project, I mean, we could put together some kind of financing and knock out a whole part of our system. The conversion, the planning and the conversion. And if you did that, you would do it to a money-making entity. It would be a smart investment because the market may go down, but this electric utility will keep making money. I mean, that would just be a smart investment. Now, if there aren't the votes and that's what I would say that you would direct that capital improvement / electric project, and I would leave electric project up there in that definition. If that part isn't going to get sufficient votes, okay, I really like it the way that we presented it. I would make one change, and that is 2.5, distribution of funds allocated pursuant to section 2.4, together with any balances in such fund, shall be immediately distributed to the beneficiary and each successive month thereafter, provided such funds. So you would talk about that those balances are moved, and then the funds would be moved automatically to each month thereafter. That would answer the issue of the balances, and but if we don't like 3 and we don't like that person, I suppose we ought to we ought to have a motion to take that out. But I'll tell you that is something that you could really provide a benefit to the money-making utility from the public trust, and to me would make a lot of sense. Although I understand everything that Mike said, it's not that much money, and it would make a giant improvement to our electric system. Greg, wouldn't it?
Excuse me, sir?
$350,000 a year?
For 3 years.
Yeah, that makes a big difference every year. I bet you. Yes.
But yeah, I think that, Bryce,
Yeah, it's just, but what we're asking for.
Let's not beating a dead horse here. I think you're preaching to the choir here, with the exception of 3. I think everybody here's okay on combining accounts and on putting the electrical thing in there.
Okay.
To help you do that. This number 3 edition with additional money coming out of trust, that's.
It's just not
gonna
allowed,
fly.
that's not gonna fly.
No.
So then I would just say that that comes
Am I
out,
correct in that? You guys don't have a problem with them combining the accounts, do you?
As no boss of mine would say, you can find some money for that
In your allowance already.
in
Yeah.
something else.
okay,
I mean, I'm just saying,
No,
there are
we'll-
ways to
no, we'll-
fund that, it just, you would take some of that out of.
we'll accept that. I was just,
Capital improvement of the
I would-
74%.
I was just giving you a 3-year,
I
break.
understand
I was
what
giving you
you're
a
saying.
3-year break.
I
You know, because
understand what
we're
you're
gonna
saying.
promise not to
Rather
come back.
than-
Have you gotten this written up
Yes,
here?
yes,
Have you
I-
got this written up here so that you're satisfied with, combine it down into 3 accounts, that's gonna
Yes,
do it for you?
yes, that's all done. I would just put this last language about the balance, and I could shoot this upstairs and we could sign it right
That's
now.
fine.
Yeah.
I think everybody's okay on that. The only thing
We don't
we'll
know
know,
till we pick something to vote on.
yeah, but I mean, in terms of discussion here, we pretty much know.
So the first option, we had 2 options. The first option takes out number 3, which it sounds like nobody is interested in. And it puts everything else that you talked about in place. So it's the first option
Yeah,
that we're
I got it.
talking about, because it's got all the language about the funds and immediately distributing the funds.
Right.
And that, okay.
And it
so
does
we already
include
have-
the 1/16th of 1%?
and
No, it does not.
takes it out.
It
Takes it out.
What is
Yes.
3 again? We missed
Oh,
it on
that was the
Saturday.
1/16th.
Add a
the extra-
1/16th of
3 years.
1%.
For 3 years.
For
It
3
was
years,
us
which is about,
asking for a little
50
bit more
million, that's
money.
about 312,000,
That's just an addition to
Yeah.
what we.
on top of what you're already getting.
Right, you got 3, then you got 2, then you have another 1, and that's a slippery slope we don't wanna go down.
It's it would be the, community enhancement project allocation.
I would speak up and say, I'm not sure I'm comfortable with combining those.
You're not,
I'm right there.
No.
oh, really? What's your reason for not?
I think it should stay, I think they should stay separate as they were originally developed. It keeps money in each water fund, sewer funds, and street funds.
No?
If we,
There's a capital improvement fund that you can use to combine those, and granted, they only kick off about $137,000 a year, that each one of those 10% is about $137,000 a year. But then you've got about $600,000 over in the capital improvement, and you can use those combined and take care of those projects, but at least they are dedicated, the public has said they want better streets, they want better water. There's a dedicated fund going to that, not just capital improvement. Under capital improvement umbrella, it's wide open,
Well,
wide open.
I guess, hey, if you don't wanna do that, I think some of us were looking at giving you guys a little bit more flexibility on combining those, and that's fine. Well, we can end this meeting real quick. I'm just a little bit, hour and a half too long.
Yeah.
But, I think our own reason was to, or at least mine, in discussions I've had with Mike in the past and others, just give you guys a little bit more flexibility. You still have accountability there, in my opinion. You have accountability there, hang yourself, make yourself hero. But, if you guys don't want, hey, that's.
I agree with David, it allows you, the council have more
Right.
flexibility to address the needs. And
Well, like
today's times, I think it's a great
still
idea.
there. It's already still there, no matter what. It's already there. We're not adding to or taking away.
Oh, I know.
The same funds are still gonna be there.
It's
But
there.
the other thing you guys mentioned,
You're
both
limiting
of you
yourself,
have
if you
mentioned
have a large
the-
need, you're limiting yourself. Today, I think it's a good idea of that one.
But that's okay with
To
me, I'm
combine,
just
right.
saying, I personally don't think, you're gonna hurt yourself having it all together, that's just my opinion. You still have accountability to the citizens of Blackwell, how you spend that. The money is all there, it's
Yeah.
just putting it together, that's okay, if that's the way you wanna do that. I just thought maybe personally it would help you kind of do some other things.
Well, and both have mentioned the council, help the council. The council didn't request this.
I understand that.
This request did not come from the council.
You understand that
Shouldn't matter.
some of this discussion came long before some people
So
said.
we've already made those changes too. We've been
But-
on this.
Hey, it don't bother me a bit.
Right.
position, I want flexibility. I don't understand why council doesn't want flexibility, but I'm not the council, and I'm not here to say what the council does or how they spend their money or anything else, so if you guys don't want it,
Well,
you don't want it.
there's the other issue, and that is the funds created over here in the investment accounts, not providing the immediate transfer of those dollars. You know, there's several points that are,
Yeah.
you know, that are,
That's one of the reasons
that are
why,
addressed
whenever I
here.
wrote out the sheet, so we could see it in chunks. You know, if we, you know, if this board's not you know, 80% comfortable with throwing all of those into one bucket, you move on and say, okay, do we wanna combine private projects and community enhancement? Do we wanna do the additional 1/16 of 1%? Do we wanna do the distribution of funds to the city on a monthly basis and remove the planning commission? We got 5 chunks there that we can figure out, and Bryce can draft a document and amend it to look however we want to, but let's decide on something, because
Yeah, if it gets complicated, I'm gonna have to look at it for a little bit. It's not something like that.
Propose, make motion.
Which one you want,
If you just want to retain the water projects, sewer projects, street projects, those percentages, because, you know, that's what I'm hearing, to get this, and then you're good with everything else, of course, taking 3 out. So capital improvements would only have 44, and we'll retain those 3. I do want to add, and I know that it doesn't have to be, I do want to add electric up there in the, you know, in the purpose, but we'll add those others, and then I'll just add back that the money from the sewer, water, and street gets immediately transferred. That does exactly what you said. If you want to keep that will do what you're interested in. And that actually won't take me that long to do.
So on these points, the only one that was stuck on is number 1.
Yeah, so we have 2 documents. One is, with the additional funding, and one without. So we'd be talking about the one without document and changing, the part about merging the water, sewer, and street, to leaving those as they are. And the balance of the other items, merging private projects and community enhancement, is everybody okay with that? Okay, and then, distribution of funds to the city, I would, make a motion that we approve the third trust indenture with the changes, to include the water, sewer, and street projects at 10%, and changing the definition to include electricity in the purposes of capital improvements.
I'll second the motion.
Somebody wants to say something?
I just had a quick question, and maybe I just missed hearing what the percentage is for the private projects and community enhancement. I did not hear that percentage.
Currently, it is 1% for private projects and 5% for community enhancement.
Okay.
So that would become community enhancement at 6%.
I did hear the 1%, but I didn't ever hear the
Yeah.
Okay. Tracy?
Greenville,
Aye.
Loftus,
Aye.
Reeser,
Aye.
Webb,
Aye.
Savage.
Aye.
Item D is consider and take action with respect to resolution number 02112020, approving and authorizing execution of third amendment to the trust indenture of the Blackwell Public Trust and containing other provisions related thereto.
Yeah, that's just approval of the resolution, which authorizes this third amendment as amended.
Thanks for all your help. Thanks for all your
no further business, we can adjourn the meeting, Blackwell Public Trust.